Good morning, all. Thank you, Graham, for that insight. Following the monumental changes announced in inheritance tax last year, this year the Chancellor merely tinkered around the edges. So let's take a look at what changed. In keeping with the spend now, tax later theme in the budget, the inheritance tax ban has been frozen for a further year until 2031. The nil rate band will now remain at $325,000 for a staggering 21 years. Back in 2009, when it was last increased, only 2.7% of estates paid inheritance tax. Based on forecasts, this will be closer to 10% by 2031. Quite an increase. The residential nil rate band, which was introduced back in 2017 to help people brought into inheritance tax because of the increasing property prices, will remain $175,000. This is available where property is left to direct descendants, and it does start to taper once gross assets exceed £2 million. Given it's really there to help people with rising property prices, it's surprising it's not going up with it. And all of these rates should go up with CPI, but given the history, I don't hold my breath. Despite a small amount of optimism and a lot of lobbying, the seismic changes announced at agricultural property relief and business property relief last year have not been significantly changed, with the government holding firm on 100% relief for the first £1 million of assets and 50% for any excess thereafter. As a reminder, assets that qualify for relief are generally farm, land and buildings and unquoted shares in a trading company. We've seen firsthand with many clients how emotive and controversial this change is and how much of an impact it will have on their livelihoods. Whilst the key rules remain the same, it was not all bad news. The rules initially prevented the transfer of unused allowance, the £1 million, between spouses. However, this has now been changed, and so you will now be able to transfer it. This gave a very unusual situation where you'd be worse off as a result of leaving all your assets to your spouse and getting the spouse exemptions. It's also at odds with the nil rate band and residential nil rate band, which can be transferred if they've not been used. The simple principle is, why should you be worse off for leaving it to your spouse? It's therefore great news that common sense has prevailed, and this will now be transferable. Is this a compromise, or is it simply correcting something that was overlooked last time? I'd suggest the latter. With IHT changes coming in, for many, the main IHT planning opportunity is to give assets away during the lifetime. In the run-up to the budget, there was a lot of nervousness around the potential loss of holdover relief, or perhaps changes to the amount that can be gifted. It's great news that these have not been touched, and you can continue to give as much as you want away. These will be outside your estate after 7 years. It's a real feeling of relief, as it could have been much worse. But it does say a lot when the good news is the fact that the changes weren't made. When the changes were announced last year, there was very little guidance on how these rules would apply for trusts. This is a particularly technical area which I don't have time to cover, but we just want to make you aware of a few key points. Trusts will benefit from a £1 million allowance, but this will be capped across multiple trusts set up by the same person. Existing trusts set up before the last budget, so back in 2024, will have full relief available up to the next 10-year anniversary. So there's a point here to think about any existing trusts and whether any planning should be done to maximise that relief whilst it's available. And another key point that's kind of hidden in the detail is that a trust does not automatically get the £1 million. It's limited to the value of the qualifying assets introduced. So something to be aware of: if you only add $500,000 to your trust, what happens when that goes up in value? The $500,000 allowance doesn't go up with it. So what does this all mean for IHT planning, particularly with BPR and APR assets? Continue to consider lifetime gifting. Obviously, there's a lot to think about. You're giving assets away, so it's not something that can be rushed. Also, it's worth bearing in mind that gift with reservation benefit rules apply, so you cannot continue to benefit from an asset once you've given it away. First death planning is slightly less relevant now with the change. Insurance, maybe take out cover to help fund the liability. And as a worst case, remember you can elect to spread the IHT over 10 years. pensions. It was also announced last year that pensions would be included within inheritance tax from April 2027. That still stays the same, but there's a couple of small administrative points that I thought would be worth covering. The responsibility for settling the IHT liability was initially with the pension provider. After much uproar in the pension community, it's been accepted that that's not practical. And now the responsibility will sit with personal representatives. Yesterday it was announced that whilst this sits with the personal representatives, they can ask the pension scheme provider to retain up to 50% of the pot for a period of up to 15 months to cover the IHT liability. Pension salary sacrifice. It seems a budget never passes without some change to pension rules, and this time salary sacrifice was in the firing line. Salary sacrifice allows an employee to forego part of their salary in exchange for a pension contribution. This reduces their taxable income, but also gives a national insurance saving for both the employee and the employer. From April 2029, NIC will apply to salary sacrifice pension contributions in excess of £2,000. Interestingly, this was the second largest tax raising measure announced yesterday, raising £4.7 billion. So let's take a look at the numbers. The table gives an example of 5% salary sacrifice on a range of salaries. What's clear to see is that the cost to the employee is relatively modest, whereas the cost to employer is significant. The burden does really fall to the employer, particularly with the increase to employers' NIC last year. It's yet a further tax on jobs and a further burden for employers. It was suggested by Rachel Reeves that this change was really aimed at those in the financial sectors, perhaps bankers, who salary sacrifice significant salaries. But given those numbers, I still can't look away from the fact it will be the employers who face more of the cost. Despite the NIC benefits being reduced, salary sacrifice will still remain useful. It's particularly useful for those people who are crossing thresholds and those who keep their income below 100,000 to benefit from free childcare. It's also very administratively simple for employees, as all relief is given at source, whereas otherwise you have to go through the process of claiming the higher rate tax relief. Interestingly, with the extra time we had to look at the ABR report yesterday, I did spot that they expect some behavioural changes as a result. Most worryingly, they expect that employers could scale back pay rises to help cover the costs. A recognition of the real impact for working people, and I will leave you with that thought. Thank you.